and then I will jump over here. Okay, give me a second. Whereby, whereby. Okay. Excusez-moi. I'm getting in.
Fidi, are you going tonight?
Tonight.
Yes. For Guinea celebration, we
Which
have
celebration?
we have an event at the base. You know it, right? Notice. We have a kind of like a movie night at base.
Oh,
You
really?
know it, right? Yeah.
I thought it's after 10. Oh,
Where? Yeah.
I
Is
was
it?
aware of the event, but I'm not aware of the date.
Oh yeah, it's tonight. So if
Okay,
you don't have
I see.
anything, you can come to the base.
What time?
It's 7.
I see. Okay.
Yeah. Okay.
I'll try
Okay.
to.
All right, let's talk about this. So the topic of today's discussion is this. So this is to do with the idea of being able to delegate correctly to somebody. So this is an open discussion, and I'll take whatever you guys think. The question is this, and this is probably applicable in Vinny's case too as well, which is how do you know if a revenue manager is doing a good job? Let's say, for example, I've been doing revenue management for a while now. Let's say I've been doing revenue management on a set of properties. So, how would I be able to evaluate if a person I've delegated to is doing a good or not a good job? Okay, let's begin this top. Oh, wow, the booking pace looks like it went down. What's happening? What's happening by you? Okay, so let's go to Vinny first. Vinny, what would you imagine to be the criteria for determining good revenue management versus not such good revenue management?
Um, First, I think the prediction.
Okay, the projection. Right.
Yeah,
Okay.
the
All
prediction.
right. That's a good one. So how what should we say about the predictions?
We want our prediction to be as close as possible, but also maintaining the profit margin,
Okay.
optimizing the profit margin.
All right. So very good. Let's go ahead and put that in a table, and we can talk about it. All right. So the contributor, and then the let's say analysis, the criteria. Okay. So this is Vidi. Vidi thinks it's about prediction, accuracy, maintaining profit. Okay. All right. Great. All right. So we have to make accurate predictions that are profitable and meaningful. Let's go to Cynthia. Cynthia, how would you evaluate the if a revenue manager is doing a good job or not?
Mm, yeah. The first time is the accuracy of the projection is on the like on the track of its margin error.
Mhm.
And the owner is complaining about it.
Okay. All right. So owner management. Yeah.
Yeah.
Okay. Owner management. Okay. We have to actually be very once again, like yesterday we discussed. Do we have any control whether or not the owner will complain? Let's go to Cynthia. Do you believe that you have control over whether the owner will complain or not?
Actually, no. Yeah. Because sometimes if we like our but I think that also depends on the partner characteristic itself.
Mhm.
Uh, but in the company that as long as I say, if you can bring a lot of guests, as many as guests that you can bring to me, so it's fine.
Okay,
Other things.
got it. So they want as many guests as possible. Yeah.
Yeah.
All right. Uh, but what if? every guest came and they only paid 10,000 rupees a night. Do you think they would complain?
No, and the owner also will complain about that thing.
Right, right. Okay. So here's the thing I'm getting to. Okay, so that's good. Owner management. Let's go back to Vidi. Vidi, is there anything else that you find is a good metric for understanding if a revenue manager is doing a good job?
Um, I think aside from predictions, from what I observed, uh, we value the value of a property. We value properties well, and if we are able to precisely give a value to the property, then we can then everything goes fo- everything follows it.
Okay, tell me more about what you mean by valuing a property. Is this related to like giving it a
Yeah.
price?
Yeah. Basically, from the yesterday we discussed about internal data
Mhm.
when we try to analyze the what's the attributes of or what are the features of this property, and then um, based on the features such as how long has it not been built, the booking window, and so on and so forth, we are able to give a value basically to our
Okay,
product.
okay, okay. Okay, that's interesting, actually. Yeah, we should be able to intuitively position and like merchandise the property correctly. Like, does it belong on the top shelf, middle shelf, bottom shelf? Okay, all right. I like that. I dig that. All right. Here's a few comments. There is one part that Cynthia mentioned about the owner management, and Cynthia mentioned that it shows like the owner complaints are difficult to manage, whereas actually you just need to know two things, right? What is disappointment equal to, Cynthia?
Disappointment equal to low income.
No, it's
Mm.
expectations
Oh, expectation. Okay, expectation.
minus
Uh, reality.
reality, right? All right. So if you don't want an owner to complain, you actually have some control over this, right? So you can either make the expectation really low. The easiest way to make owners not complain is to lower expectations and raise reality, right? So a revenue manager actually has the capability to do both, and that's what's actually kind of funny. The expectations is what? What is the expectation side of revenue management? Cynthia.
One's expectation. High income.
Oh no. How does
Oh,
the revenue manager
oh,
set expectations for the owner?
oh. Uh, we bring the projection.
Yes, very good. You can control expectation by your projections, right? Okay. And then how do you control reality?
I couldn't control reality, sir.
Oh yes, you can, right? That's why you're a revenue manager. What do you practice on a day-to-day basis to make the revenue better?
Um, pricing.
Yeah, yeah. You do pricing, right? You do the RM control. You look for
Yeah.
you look for revenue risk,
Yeah.
and then you price, and then you
Price.
sell empty room nights, right?
Yeah.
So actually, in kind of a realistic way, you actually do have control over owner's expectations. So the journey is very important. The journey of telling the owner what to expect in the beginning, and then making it consistent to what they do. Now, oftentimes owners get disappointed or they complain because they're not focused on the part that they had already agreed to. Now, how many times have you reported to an owner, hey, look, we've exceeded the projection of your monthly revenue? And they would go like, great, right? Or they would go like, no, terrible. So if you want to control how owners feel, you need to go back to the projection that you set in the beginning and measure each month accordingly. So Let's say, for example, you have even a bad month. Let's say you're below projections. Cynthia, do you think you should report that to the owner or not?
Yes.
Yes. Okay, that's good. Why should you report it?
Because we should be transparent to the owner about the condition and the
Very
situation.
good. You can be transparent to the owner, but you also get another big benefit, which is you can steer the conversation back to a part that you can control, right? Which is around projections and this. If the conversation goes to the nightly rate is too cheap, or these guests, I don't want them to have Chinese guests, coronavirus, or whatever it might be, then you might have a problem actually steering the conversation. But if you could always bring the conversation back to the projection and how you did, then that becomes actually a very powerful tool to manage owner expectations. Does that make sense? So as long as you're talking about something that you talked about in the beginning, then the owner should not have any complaints. I mean, sure they might complain, but they wouldn't complain about, let's say, anything else, right? As long as you can focus the conversation on this particular subject. That's why it's so important to have the projection and the patrol. If you just do the patrol without the projection, then the owner will complain. They'll say, "Hey, you're selling my place too cheap." But you can say, yeah, I'm selling your place too cheap, but we made $2,000 over the projection. Maybe that's not such a bad thing then, right? Maybe cheap is good. So, but it's like they made 2,000 over, well, what, right? They've had no expectations before. So once again, that's the value of the projection, and being accurate on the projection allows you to have more control over how the owner feels, and that is the ultimate goal of a good accurate projection. Okay, so tying it all back up to people metrics. Okay, let's talk a little bit further about what I think this is. We have career metrics here at Bukit Vista. So I would say for, let's say, PCI work here is essentially, all right, what does a revenue manager should do? I think they should be able to conduct a good revenue management patrol. They should identify traditional revenue risks, right? Um, Being able to identify traditional revenue risk, meaning like unsold nights about to expire. We all know what that looks like. The villa is empty tomorrow, right? So that's a traditional revenue risk. They should be able to identify short runway, long booking window situation, right? So if you have, let's say, a 10-bedroom villa and the next nights are empty for the next 2 weeks, then that's a really big risk, right? That's a long booking window and a short runway. So that's a traditional risk. Let's keep on going. What's another traditional revenue risk, Cynthia?
About identify let's talk about the next player. How about the what is that? We used to call it with lapangan. A lot of unbooked night.
Okay, so we say that's too much availability, right?
Yeah.
Okay, that's pretty obvious. That what that looks like is when you look at the calendar, there's no bookings on it, and it's completely empty, right? So that's probably one of the leading red flags. What's another red flag? Let's go to Vidi. Vidi, based on our conversations about the formula, I think on the weekend, what's another like traditional revenue risk?
Uh, the red that we discussed was the initial, um, what do you call it? Like there is a gap between the initial starting point between each one.
Vidi, you're gonna have to speak up. Uh,
Ah, the gap, the low initial revenue in each month.
right, okay, a low starting revenue, yeah,
Yeah.
versus previous month. Yep. Okay. All right. That's great. Slow booking pace is another one, right? If the booking pace is really slow, that's another revenue risk. Um, Gap nights, a lot of unsold nights in the middle of bookings. That's another type of revenue risk. Yes, to video.
And also, too quick of a booking pace isn't good, right?
Yes, right.
There might be
Too
something more about it.
fast booking pace and too early sold. Okay, when you sold too many advanced bookings. Okay, right. What else? Is there anything else? Cynthia, let's go to you.
Mm, wait, so I just I, I'm not sure. I've just like identify here right now, and yeah. Oh, sorry, sir.
Okay, no worries. That's quite a lot already, actually, right? So I think part of PCI work for a revenue manager is simply put, they should be able to see these red flags. When they go into the calendar and they look at the data, they should be able to like, oh, okay, all right, there's some things not happening here. Okay, the other ones is I think they should be able to um, let's say process competency. I think they should be able to, let's say, on the RM patrol, be able to prescribe the correct action. And remember, in this particular case, all we have is two controls on revenue management. What are the two controls that we have, Shantia, in revenue management?
Um, Rejection.
We talked about it yesterday, the two levers.
Oh, I'm sorry, sir. I forgot it.
Okay, let's go to Vinny. Vinny, what are the two controls that we have in revenue management?
We control the price,
We control the price, and we
and we
control the
what's the other thing? I think we control this profit or revenue or timing. Timing.
timing, yes. So we control the pricing and timing, right? So if there's unsold room nights, okay, so then you can take a look at a matrix, right? You can take a look at what's the problem and what's the solution, right? So I think a PCC person should be able to do this. They should be able to prescribe the most suitable solution to each of the corresponding revenue risks, right? So if you have unsold room nights that are about to expire, well, what should you do, right? If you have a short runway, long booking window, well, what should you do? What price, what time should you actually act? So these are essentially the PCC components, I think, of a good revenue manager control. Okay, let's talk about forecast. Is forecast a PCI skill or is it a PCC skill? Um, let's go to Shindia.
Forecast. PCI.
Forecast, I would say is a little bit difficult, Shindia. It doesn't seem it's just like a PCI skill because you have to remember forecast is still something where there's a lot of variables. We don't like you can probably teach a person in one day how to detect these things, right? These red flags. But do you think you can teach somebody in one day how to actually make a forecast?
Oh, okay. So it should be on PC.
I think so. I think the aspect of actually making a forecast means you're taking some knowledge that we have and you're able to adapt it to new things that we don't have. Now, if we ever come up with a formula to make a forecast, then it becomes PCI work, right? You just plug in the numbers into the formula and it will give you a forecast, right? So, but currently still to do a forecast, I think that's kind of like actually process competency really need to think about you really need to think about like what are the conditions, what are the variables, what's the location, what are the size, what to compare it with in order to get an accurate forecast. So that's it's essentially a price and revenue prediction. Okay, let's keep on going. What would process excellence look like? What would let's say, superb revenue management look like in this particular way? Ah, Vidi, what do you think superb revenue management process would look like?
Is this like an opinion question? Like what I think an excellent
I'm gonna have to have you speak louder again. Sorry. Go ahead.
is this like what I think an excellent revenue
Yes.
management?
Yes. What would you believe an excellent process to look like?
Right. Um. Yeah. Maybe being able to understand and process the uh multi variables.
Oh, wow, that is cool. What does multivariables mean, Vinny?
It's when you are able to consider the effect of one variable to the others and also the outcome. So
Okay, very
being
good.
able to keep track of those variables, I think, is very impressive. That is nice. So,
Okay, influence of multivariables. Okay, that's one way. But generally, let's say if we were to abstract it a little bit, here's this could be the solution. Ultimately, what PCE means, like let's say to the craft of revenue management, is essentially two things, right? It's efficiency. So it's efficiency in reducing the time and being able to increase the load, right? I would imagine any process excellence means that whatever we do, we can spend less time doing it, and we can add more variables. We can add more load to it. We can add more inputs. We can, let's say, do revenue management for 1,000 properties while maintaining the same time that we used to do for 100 properties. Or we can revenue manage 10,000 properties given the same amount of time, right? I think it's anything that also increases the accuracy, right? So it reduces the amount of error. So before, let's say we have maybe a 10% likelihood that we'll get the pricing right. Now we have, let's say, let's say a 90% chance that we have the pricing right. So anything that improves the accuracy and reduces error. Um, Anything that I think is more comprehensive, meaning more red flags, right? If you're able to identify more red flags and oh yeah, this is a new revenue risk, this is a new risk, then that's also better. That improves the process so that we have higher visibility. Um, okay, all right, cool. That is essentially how I would say the structure of good revenue management should look like, right? A person who's doing PCI should be able to do a revenue management control and be able to identify where the key problems are. Somebody who's more process competent should be able to do the control and find out if, let's say, what the correct actions are to fix each problem. And they should be able to forecast accurately. Somebody who's doing process excellent is going to bring new processes in. They're going to be able to like invent a new process. And it could be like what Vidi said. Like maybe it's a multi-variable function. Maybe it's a neural net. Maybe it's artificial intelligence. Some sort of new method that would greatly improve the efficiency and the accuracy of the revenue management process, right? But it would have to be both at the same time. If you improve accuracy, but you diminished efficiency, that wouldn't be so good. So let's say we spent, on average, let's say 10 hours a week on revenue management, but the new process takes 100 hours a week and we get 5% more accuracy. So I wouldn't necessarily call that process excellence. You've just taken a lot more time to produce that accuracy. But if you could use less time to get more accuracy, that is a form of process excellence. Okay, these are good to know because they allow us to actually take a more managerial approach and a more thought level approach to this particular discipline. Okay, here's actually a question I ask myself a lot. Right, I love asking this question because it's really fun. Let me show you the all hands. On the all hands, we have actually a part we do the profile, and we see who's working on essentially the profiles of each particular property, right? Okay, from a revenue management perspective, how would we know if somebody who is doing the reservation work for a particular profile, are they doing that reservation work better or worse than the previous person? Okay, so here's the question, right? I'll bring us to this. Okay, this is a good question for Vinny too. Who's thinking about evaluation. Okay, let's say for example we have this. We have the Jingle profile, right? And this profile is being managed by two people, not for revenue, but as revenue managers, we should, the profiles are our revenue engines. So we want to know, we want to evaluate, are Lucky and Rion doing a good job managing that profile, right? So how would we actually get to know that? This is all we have right now. We do have the revenue data on that particular profile. We can go to the growth and we can see the profile, and we can kind of see over here how the profile is doing. Okay? So then my question is this: how will we be able to estimate if this profile is doing good, bad, worse compared to everyone else? Or compared to what? Let's go to Cynthia. Cynthia.
Yes, sir. Based on my experience, I think it's kind of difficult to identify is if the profile is working better on who, I mean like who handle based on the who handle the profile itself,
Okay.
because it's also um, about the seasonality itself, and yeah, the growth rate depend on the profile growing right. So I think this is the seasonality also matter here, and yeah, it's kind of difficult to identify is it working good or not. Yeah, about the person who handle it, but actually it also can be tracked on. We have the inquiry converted and also the request converted, right? And then we can see from that data as well about how good that profile works.
Okay. All right. How do we evaluate profile performance? So, if I understood you correctly, Shakira, you're saying it's difficult because of seasonality. Okay. And we can look at the conversion of inquiry and requests on the profile, right? Okay. All right. Interesting. All right, Vinny, what are your thoughts? How would we be able to, as a revenue manager, understand if the reservation teams are supporting our revenue ambitions? Are they supporting our sort of revenue targets?
Right. So a profile means the team, right?
Um, okay. Oh yeah. Sorry, Vinny. Let me show you what a profile is. So
Yeah, yeah. I'm not. I'm still not familiar with the term.
okay, no worries. Here, let me bring you through it. So basically, a profile is a collection of listings on an Airbnb account.
Yeah.
So one particular profile might look like this. I'm loading this, and it's taking just a little bit long to load, right? Um, so one profile might be how would I be able to do you know like eBay, right?
Yeah.
Or like Tokopedia. Let's say, for example, you have a Tokopedia profile, and on that Tokopedia profile, you sell coffee mugs, tea glasses, and wine glasses, right? So essentially, the combined revenues from the products that you sell on that profile is the performance of your profile. So,
Right.
like for example, uh, the profile in question right now is a Jingle Wayana profile. So this is a profile, and then these listings are all the products on that profile. So you can see we have 45 listings And so these listings are essentially out there producing revenue for this profile. And the question is, if we take a look at basically our entire revenue comes from the sum of all the different profiles that we manage on Airbnb. Cynthia manages, I think, two or three profiles, mainly for Nusa Penida. Different teams, they manage these different profiles. And guests will be sending reservation inquiries, they'll be putting in requests, they'll be making bookings on these listings that are grouped together as a set in a profile. Okay, so the question is then, how do we then understand if the people who are managing this profile, like Lucky and Rian, how are they doing? Are they doing a good job or are they not doing a
Yeah.
good job?
So the individuals themselves, right, or the people, the individuals who manages the profile, right?
Yes,
Um,
let's just say as a team, we can't break it down.
yeah, as a team, yeah.
Yeah.
So um, one way to ask actually, uh, I don't know, like have we ever tried to visualize the data, like or plot it out, like whether we can observe, whether we can uh, find patterns or cluster this data
Sure,
such as
this is it, right? This is like one of the simplest things. This is tracking the revenue of the Jane profile over the
yeah,
past 6 months.
yeah. But in this kind of scheme, are we able to like compare? Are these profiles comparable? Is it like is it apple to apple comparison?
Very good. Right. So that's a good point. Are these comparable?
Yeah.
Kind of. If you can have like a memory and remember what each one looks like, you know, as we scroll through the different profiles, then yeah. But they're currently they're not visualized in a way that's overlapping.
Yeah, yeah. Yeah, I was wondering, like, well, if we can, for example, if we have a map, right, and this map separates, uh, does one profile, does each profile cover different areas, like specific areas,
Yes, they cover different areas. That's correct.
right? So, in a sense, we can, like, if we compare one profile to another, like directly, like verbatim or like not verbatim, but sometimes it could be tricky because maybe the listings contained in one profile cannot be compared directly in terms of values, right? But
Right.
then if we can kind of like visualize it in a way it distributes, um, it's normalized basically the
Very
data
good.
are
Very good.
normalized, we are able to compare it directly.
Nice
Basically,
answer.
normalize the data.
Great. I like the word you use, normalize. What do you use as, let's say, the most relevant normalization factor? What would normalize all the different graphs?
Um, the, you mean the method?
Yeah.
Yeah,
What would give us, let's say, the most normal? There's going to be different listings. These things
yes,
are in
yes.
different areas. So how would we actually? There's going to be different seasons. What would be the best way to understand normalization?
So you have to understand that first, if we try to consider the variable seasonality, then we cannot compare, for example, like from high peak season to the normal season, working season, right? So it should be segmented. Then within itself, you take the maximum value affected by the minute value. No, the value itself over maximum minus minimum. So you get kind of like a value only between a certain range, basically.
Okay. Interesting. Okay. All right. Here's the reveal. If you could plot these lines of different profiles the same way that we plot for different squads, Shithya, then that would help, wouldn't it? So different squads have seasonality, and we can kind of assume seasonality affects every squad more or less in the same way. So let's say, for example, squad one and squad two, right? You can kind of see at what point did the squad two performance actually start doing better than the squad one performance, right? There was that crossover day right here in September 2019 when things started looking differently, right? And why was that? Because essentially the performance and the revenue and the entire stack of information, you can see they track each other, right? But one is now definitely higher than the next one. In the first 4 6 months In the first 8 months of the year in 2019, Squad 1, the blue line, was always above Squad 2, right? Always above Squad 2. There was a margin. But then after September, there was a crossover. And then ever after that crossover point, Squad 2 is always above Squad 1. So there's kind of a clear signal to anybody who reads it. The revenue has been managed better in Squad 1 versus Squad 2, right? Now, we've been here long enough to understand that implicitly just from living here and seeing what's been happening versus each squad. But also, it's really good to graph it out and be able to see when you compare two graphs, that's how you're able to see relative performance, right? Are they doing equally well? Are they doing differently? Now, of course, let's take into account a profile like Jing and Wayana. This one has a lot of big properties in it, has a lot of big villas and such. And perhaps the capacity of such a property or such a profile is much bigger than a smaller profile, let's say, for Nusa Penida, right? So then, how would we compare then a Nusa Penida profile in terms of how well it's being managed against a relatively large profile like the Jing and Wayana profile? Let's go over to Cynthia. Cynthia, let's say we were going to compare your work on taking inquiries and bookings for Emil's profile versus the Gina Wayana profile. Now, we know that there's seasonality. Okay, we can take that into account. But we also know that no matter what, the Emil profile will not make the same amount of revenue as the Gina Wayana profile. Now, that's not what we're asking. We're asking, are you doing a good job on your profile compared to the person on a different profile? So it's kind of like driving. Now, if you drive a bigger car, you're probably gonna, like make bigger tire marks on the road, right? But that doesn't necessarily mean that you're a better driver. So how do we then compare the skill of a person who is managing the account from one profile to another profile if each profile has a different capacity? Let's go to Cynthia.
Mm, well, I'm not sure, but here's my answer. So I think we could check based on the data, like we can check about the percentage of the properties itself and also the percentage of the inquiries that coming, comparing to inquiries that converted, and so there's about the request to book. But yeah, uh, I'm still thinking actually about that things, about how good the performance of each profile. Yeah.
Let's go to,
Uh,
let's go to Vinny then. Vinny, do you have any ideas? How do we compare performances of different profiles that have different capacities for revenue production?
Um, uh, I'm not sure, but yeah, again, same answer just now. I think normalization is possible.
Okay, so without the correct visualization, it becomes difficult, right?
Um, I mean normalization. We normalize the data.
Okay, interesting. Here's what we've been doing traditionally in terms of because we do this evaluation when we promote people on online guest support and also host, right? So this is actually pretty relevant to the whole scope of revenue management. What we generally do is this. Let's say, for example, we're going to take a look at the Jing and YM profile, right? So we go ahead and we cruise on over and we take a look at the shape of this. So then we kind of take and we screenshot this. Okay.
Sir, that's
Yes.
June and Bukit Vista.
Uh, uh,
Or you are looking for Jing and Wayana, right?
yes. I'm looking at the. Right. Good. Thank you. Thank you. Thank you. Yeah. Very good. Good catch there. All right. So we take a look and we screenshot the Jing and Wayana profile. Okay. And then what I generally like to do is I go back to the main revenue for the entire company. Right. Yeah, Vinny gets it, right? And I look and I see, does it actually follow the same curvature as the company? If it follows the curvature of the company and it beats the month then I would know that it's contributing more than the rest of the company, right? Oh, okay. Let's take a look at this. So let's take a look at the entire company. Actually, we can probably take a look at. Okay, let's take a look at the entire company, and then let's take a look at the last 6 months, right? Okay. So then okay, all the way back to September. Good. All right. So now I'm going to do this. I'm going to use my handy dandy paper until Video and I are working on some nifty OCR thing that will be able to like put this on a spreadsheet, right? But in the meantime, what I'll do is I'll just take a look really quickly and I'll compare the shape of both graphs. So what I'm looking to understand is this, oops, uh, sorry. Okay. Okay. What I'm looking to understand is, did this have relatively the same performance or worse performance than the entire company? Now, if it had relatively better performance, then great, right? It means that as like a profile, it was contributing more than its share. If it had lower performance, then you could say it's contributing less. So the way I would do this is this. I would look at a table of ratios. I would look at the ratio between the lowest month and every other month. Okay, so you guys ready to begin? Here we go. All right, so this is fun. This is fun for me, but hopefully it's fun for you too. Okay, so the ratio, and then let's say let's say the profile. Okay, and I know the lowest month is November. Okay, so what I'm going to do is I'm going to compare. I'm going to compare the September to November ratio. I'm going to compare the October to November ratio, right? And then I'm going to compare the December to November ratio, and then I'll compare the January to November ratio. Okay, so this is how I normalize everything. I'm going to see if the Jing and Wana profile compared to the company profile, did it do better as a ratio of the lower month to the highest month than the company? Now, if it did, it would mean that it's making more impact to the company than whatever anything else, right? It's making higher impact to the company. If it did lower, it would mean that it isn't doing so well. Okay, does that make sense? Okay, let's go ahead and discover. Let's give it a shot. So the September ratio is, I'll just round to the nearest thousand. So it's 60 divided by 52. So that ratio is about 1.15. 1.15 is basically the ratio from the September to the lowest point on Jing and Wana. Let's take a look at the entire company. The entire company, the ratio was 365 divided by 272. And that's 1.34. Okay. All right. So then my question is to Cynthia. Did Jing and Wana perform better or worse than the entire company from in September?
Mm, um, wait, it's better?
No. Vinny, did Jing and Wana, okay, that makes it really easy, right? Did Jing and Wana perform better or worse than the
Yeah,
entire
it
company?
means that the rate of decrease is lower
Yeah, it's
because
it's
it's
worse.
decreased.
Basically, the entire company's ratios, we should have seen a higher contribution from Jing and Wana in September. We know that if we averaged all the profiles together, Cynthia, we were able to get 1.34. So what we know is some other profile added to Jing and Wana's profile got us to a higher average than this. So that means Jing and Wana was actually pulling the average down, right? And not contributing more. If Jing and Wana was contributing more, it would have been a ratio of maybe 1.5, 1.6, 2. So we know that some other profile was actually pulling the average up, and that's why we were able to get a higher gradient across the company. Okay? All right, let's take a look at the October ratio. The October ratio on Jing and Wana is 57. and that's also divided by 52. Actually, I should round up. Sorry. It's 57.7 is really like 58 divided by 52, and that's 1.11. Okay, let's go and see what it is for the company. Cynthia, what ratio would I use to figure out the company's ratio between October and November? Cynthia, you're muted.
Okay, I'm sorry. It will be 320 and divide by 273.
Yeah, great. 1.17. Okay, so 1.17 again, right? Lower than the company ratio. So once again, that means somebody else in the companies had to pull the Jingawayana up, right? Because if we only had the Jingawayana profile across the entire performance of the company, we only get 1.17. So other profiles were what pulled up the overall average. Okay? All right, let's go to the December and November. All right, Cynthia, how do we calculate the December to November for Jingawayana?
It will 62.
Yep.
We divide with 52.
Okay, 1.19. Okay, and Vidi, how do we calculate the one for the entire company?
329 divided by 270.
All right, great. 1.20. Okay. Now you can see in this one, they're almost the same. So in this one, the JY profile did relatively the same, but still lower than the company ratio. Okay, last month is January. So I'll just do that real quick. That's 65 divided by 52. So we get a ratio of 1.25 for Jingo Wyana. And then for the company, 345 divided by 272, and that's 1.26. Okay, 1.26. Okay, so what do we know objectively about the Jingo Wyana profile now? It should be a
We know that the profile is not work better than the company. I mean, like, yeah.
we know that it's actually suppressing the growth. And every month it's performing less than any of the other ones. So that means something else is growing much faster than this profile. And that's why the company overall is growing, right? So that's just how we know that this profile is underperforming compared to other profiles. Make sense? Okay, and then what you can do is you can look back in time. When did Luki and Rion start managing this, right? And if you see that there was a switch over, right? If you see that there was a switch at one point, maybe it was higher than the company average, and now it's lower, then you could then objectively say that these people are not managing the profile as well as what it did before. Okay? But in general, I would say that the trend seems to be improving since October, right? You see these numbers, they're getting closer and closer rather than further and further apart. So I can also say that it looks like the current managers are doing better than if there was managers that changed in the middle, then they're doing better than whoever it might have been. So the ball is improving. Okay? Okay, great. That's pretty much it for today. How good is this? Is this helpful?
Yeah.
Yep.
Okay, great. So these are the tools that you can use to evaluate somebody else's performance if you're about ready to delegate. But it's also useful if you're doing machine learning, right? Because it's how you can test your models and see if your models are better or worse than whatever they were before. Okay? And Cynthia, later on when you delegate, let's say your work to somebody else, like let's hope Dista joins us. We had a conversation today about how important it would be to get Dista to join the company. It's essentially like somebody who's already really passionate, we just got to push them over. But if Dista is managing your profiles, this would be the way that you could actually understand if she is managing your profiles well. Okay?
Yes, sir.
Okay. All right. Good stuff. Really fun to have you guys today. Come again tomorrow at 3 o'clock if you guys want to learn more about revenue management. See ya. Motion.
See you, sir. Second that.
Okay, cool.
Bye, sir.
Bye bye. Oh, wait.
Yes.
Did you get the